This is Wall Street Week. I'm David Weston. Tech, and most recently generative AI, has been driving the economy and the markets. And Silicon Valley is something of a poster child for what tech has become. But we may overlook other places where tech is making a big difference. Places like Oregon.
So Oregon's really well known for having a lot of semiconductor-related manufacturing. And over many decades, that has continued to grow. It started with Intel's, one of their largest operations in the world is based in Oregon. They employ well over 20,000 people here, do a lot of R&D. And Intel plus the supplier network for semiconductors really accounts for over 30 billion in gross regional product here in the state and employs well over 100,000 people in terms of the tech sector, broadly defined. In terms of the proliferation of tech outside of Silicon Valley, we also have a really robust startup ecosystem here in Oregon, and a lot of companies developing a lot of business application software, as well as some consumer-facing applications as well.
It is not just Silicon Valley. You can go to Oregon. That's the home of chip manufacturing and has been for 2 decades or more. We have Silicon Slopes in Salt Lake City, a burgeoning community. Even in periods, and people think of it as Northern California, but LA has a considerable amount of tech, and Boise, Idaho is building itself up as a tech center. Now, they all do different kinds of things, but to suggest that Silicon Valley's the only thing out there is really a misnomer.
What is the reason why you have such a concentration of tech in your district? I mean, we tend to think of Silicon Valley as being close to Stanford and Berkeley and some universities. Is it the educational system there? Is it some other factors? Is it just critical mass?
I think there is a bit of critical mass, and there's a number of research studies that say, these network effects are large. So one of the things we've seen is, and you see this anywhere in the country really, is that people might start in Silicon Valley, they might start in Austin, Texas, they might start in Boston, but then they move. Family things take them other places. We have a lot of lovely states to live in, so people go other places. And then they build those tech centers around them because they have the expertise.
As strong as the tech sector is in Mary Daly's region, commercial real estate has been struggling a bit, as it has in some other major urban areas.
I was just in New York recently, and it seemed a lot more animated than certainly parts of downtown San Francisco. But again, I think the venture money is here, and we have a highly educated population. So as a labor market, literally no one can compete with the Bay Area. And that force for what the future is with some of this new technology is what's going to animate these large agglomerations: San Francisco, Boston, New York, and Los Angeles, Houston, and Miami, because of what's going on in financial services and the relocations in Miami. So I'm not a doom loop person at all for these cities. I think they are going to recover. There is going to be pain. As I just said, there are defaults, there are losses, there is retail closure. And I think the mix of real estate, especially in downtown San Francisco, where we have very little housing. So it's very dependent on the workforce for animation. And without that workforce, without a return to work, San Francisco is going to be challenged, whereas New York has a good mix of housing and office space within the urban core, Boston to the same degree. And San Francisco is going to have to figure this out with housing and to reanimate parts of its downtown.
Commercial real estate's a big name for a lot of different segments. So if you're in industrial and warehousing space, you're feeling very good about things right now. If you're in retail space or even multifamily housing out in suburban areas, then you're feeling really good, you're confident. The place where you're seeing weakness, and everybody knows it, is in the urban cores of particularly cities like Seattle, Portland, San Francisco. LA is doing a little bit better, but you can find pockets of this in LA. And that has to do with the fact that a lot of people are still working from home in those communities. Those big office complexes that were built up for those individuals to work in, they just aren't. They're not filled, and so there will be a repricing and a resettlement. The thing is, we've known it's coming for a while, and I see private equity money, venture money sitting on the sidelines, ready to come in when the price is right. So there'll be some repricing, there'll be some loss of valuations for sure. but it doesn't seem today to be the kind of disorderly adjustment that you would worry about. It's something that is more orderly, even though it's certainly going to be painful for those involved. It's not is likely to be as disruptive.
One of the concerns is about regional banks, which tend to be more exposed to commercial real estate. And then we've heard about that from the Fed in Washington.
Absolutely.
Some concern about that. How do you assess it out there? You have a little experience with this, with Silicon Valley Bank and things like that. Well, how do you assess the risk for the banks, the regional banks?
Yeah, so I would separate the failure of Silicon Valley Bank, Signature Bank, and First Republic, which really, they all three had the same experience, which is depositors who were uninsured ran. And that's a different situation than the commercial real estate. But what that situation did, is it alerted all investors and depositors to the fact that there's a portfolio underlying the health of a bank, and we should focus on that portfolio. I think it's useful to remind people, too, we have over 4,500 banks in the United States and only 3 failed. So the banking system is safe and sound and resilient, but there will be adjustments. And one of the things that you've heard the Vice Chair of Supervision, Michael Barr, speak about, and the FDIC chair and OCC, is really focusing their efforts on ensuring that banks are preparing for those adjustments. So it's certainly there. The final thing, though, that I think is really often not known is that regional banks don't have a lot in these big urban core office buildings. Those are really investor owned. And so it's useful to separate the concerns you might have about regional banks on commercial real estate from those big, monolithic, empty buildings that everybody's worried won't get filled.